Hello, everyone. Welcome. I'm Catherine McIntyre. I'm a reporter at The Logic. Thank you for joining our conference call today. These conference calls are regular events we do. They are an added benefit to your subscription to The Logic. Today, we opened up the call to everyone. So I'd like to welcome non-subscribers who are joining us for the first time. And hopefully this will give you a bit more of a sense of what The Logic has to offer. Thank you for joining. So today we're going to be talking about venture capital in Canada, the trends, the anomalies that we've seen over the last year or so, and what we might expect going forward, at least in the near future. And here to talk with me about this, I've got three venture capital experts focused on different corners of the industry. They've got some interesting, unique perspectives to bring to this conversation. I think it'll be great. So just before I introduce them to the audience, just want to let you know that please submit your questions to the Q&A section on your screen. We're going to be taking questions throughout the conversation, so don't wait till the end. Get them in. All right, to the panelists. We have Danielle Graham. Danielle is a venture partner with Archangel, which is an angel investment network of funds based in Southern Ontario. They just closed their first fund, so congratulations. Danielle's work has focused largely on unlocking early stage funding for startups, particularly startups in underrepresented groups. That work has included founding Fierce Founders, which is a Waterloo-based tech accelerator and the first in Canada focused on women entrepreneurs. And then from Vancouver, we have Manica Blain with us. Manica is a venture partner at BrandProject. BrandProject is an early stage venture capital firm focused on consumer retail, really interesting space right now. She moved into venture capital from the private equity world, and before joining BrandProject at the beginning of this year, she had co-founded Campfire Capital, which funds businesses at the intersection of tech and retail. And then we have Nayla Chebli. Nayla is a venture capital investment director at Caisse de dépôt and Placement de Québec. Caisse, or CDPQ, manages investments primarily for public retirement and insurance plans, and that includes some $55 billion in technology investments for early stage venture funds. It also directly funds later stage companies, post-IPO firms. Nayla also has a background in private equity and mergers and acquisitions before that. Thank you all for being here. We've got a lot of ground to cover, so let's get to it. I want to start with big valuations that we're seeing. So there have been a bunch of companies in recent months reporting valuations of over $1 billion. That kind of coveted unicorn milestone that has been fairly rare in Canada. There was a recent one, I think, last week. Ada, which is a chatbot company in Toronto, they closed a $130 million round, which got them a $1.2 billion valuation, US dollars, that is. And then there's been, a bunch of others: Dapper Labs, Benevity, Wealthsimple, Verafin. Some of these valuations have come through buyouts, not necessarily venture financing, but these numbers are intriguing. So I'll go to Nayla first with this question. I'm wondering, are these headlines that we're seeing, are they spotlighting outliers here? Are these kind of rare winners of this moment, or are they reflecting a broader trend? What are you seeing in terms of valuations across the board with the companies you are looking at now compared to a year, 2 years ago?
Sure. I think, Catherine, to your point, I think it's really the question and the, fundamental trend of the moment right now in VC. So definitely, speaking for myself, maybe just as a quick intro, so that everybody understands a bit where where, you know, CDPQ plays in terms of direct investment. I think you mentioned it in the introduction, but, you know, we tend to come in direct investing at a Series C, Series D level, and we do have this investment continuum. So we invest, you know, in later stage as well, in pre-IPO, at IPO, and once a company has gone public. So we definitely have that visibility, kind of seeing the company growth at those different stages. But to answer your question specifically, you know, I went back through my notes and went back to the, you know, transactions and companies that we've looked at, you know, 2 years ago. And just at the Series C mark, I mean, we were talking about ranges around, you know, a $300 to $400 million valuation. And now we're talking about 600 to 7 million plus. So there's definitely, I mean, you know, valuation has more than doubled, tripled in certain cases. So definitely not an outlier. You've cited a few examples at different stages of growth. Not an outlier from what we're seeing, definitely a trend and something that's kind of fundamental to the market and VC as we're seeing it today.
Okay, Manica, I'm also curious what you're seeing on this front in consumer retail. I know there's been a lot of talk around excitement activity happening here. What are you seeing there?
So at our stage of BrandProject, we invest in pre-seed and seed businesses, so a little lower down the pipe than Nayla. And I would say, you know, certainly we've seen valuations increase quite a bit. I think the lines have also become quite blurred between, you know, sometimes what you'd consider a pre-seed or a seed or a Series A. I've seen Series A's this year that had certain types of moats garner valuations, you know, in the almost Series A valuations in, you know, the almost 80 plus $90 million valuation mark, which for a Series A in the consumer space is crazy considering what I've seen in the last 5, 6, 7 years. So I would say, you know, depending on the subsegment of consumer that we're looking at in terms of trends and and overall growth and attention, you know, and depending on the potential moat and competitive moat in the specific company, whether it be supply chain or TC approval, FTD approval, you can certainly see much higher valuations today than you saw a few years ago.
Okay, yeah, and just to kind of get the lay of the land across sectors or stages, Danielle, I'll go to you with this question too, and I'm particularly interested at the angel stage. You know, at the start of the pandemic, VCs and some companies were talking a lot about capital freezing here at this stage, where risk is high, you know, where companies maybe haven't met face-to-face with investors they're pursuing. When you're looking at companies who are in many cases raising for the first time, like what are you seeing here in terms of deal activity?
Yeah, well, absolutely similar trends around growing valuations and changes in what is determined to be a pre-seed or seed stage deal leading up to Series A. And so all of that is being redefined. And that's a pretty consistent factor because it is based on trends. It is based on the deals that are coming forward. But there's always a place for kind of those first investments and what that looks like for an angel stage pre-seed deal. And so we are seeing that same opportunity, but it's been a big gap in Canada for a long time. So to be able to pool capital into an angel stage fund, be able to unlock more of that capital on a collective basis is a critical element that hasn't existed for a long time, is a bigger gap in Canada than the US by a significant margin. And at the same time, these deals that are very competitive are still moving forward faster, have higher valuations, and are getting the VC grade treatment in terms of valuation. So we are seeing those same trends at the angel stages. But I would also say that overall, the angel stages are still engaging. I think people have adapted, so they're willing to meet virtually versus in person. And there was a bit of a gap in the beginning stages of COVID, and we rallied to do a specific COVID leadership initiative where we pool capital to invest in COVID solutions. But overall, I think even the angels have adapted.
Okay, yeah, that's interesting. I want to push a little bit on why we're seeing this. So, you know, we're saying this is a trend kind of across the board here to varying degrees. What's causing these high valuations in the competition that we're seeing with startups here? Manica, do you want to take a crack at that first?
Yeah, sure. I mean, to build upon what Danielle just said, I think we're certainly seeing more angel groups and more founders seeking angel investment. There's more participants at the table at that stage, and there's also more participants at the table that would normally not participate in a seed round. I'm sort of addressing the tiger in the room here. So I think there's two factors in terms of within my sector and within my specific stage of investing, why we're seeing some valuations that are much loftier than they were a couple of years ago. I think it's welcome to have more participants at the table from a founder perspective, for sure. But from an investor perspective, it becomes a little bit more challenging given the higher valuations.
Nayla, what are you seeing on your end on that?
Sure. I mean, it's, definitely a question that we kind of reckon with every day, and we've been looking at it at all from different angles internally. I think there's a lot of, I think to Daniel and Monica's point, there's a lot of fundamentals going on. So a combination of, pandemic that have accelerated, trends of work from home, digitalization, everything's happening online right now. So a lot of that is definitely happening to the help of technology. So really kind of putting on the map a lot of companies that, we're already on accelerating trends, but just kind of re-accelerating even more now following the pandemic. I think other points to consider as well is that, companies are actually delivering right now. So, I look at a lot of companies in our portfolio. It's not like, yes, COVID was a situation at first where everybody just stopped and kind of, okay, how is this going to impact my business? What should I do moving on forward? But the reality is, if you look at, revenues, if you look at growth, I mean, companies are delivering today. So in the technology space, at least, things are going well. There's actually acceleration in certain sectors. So also driving, valuations higher just by the sheer fact that revenues are growing. I think another point that, Monica started mentioning was the fact that definitely lots of capital in the market right now. So even more than what we're used to in the past. I mean, just, giving you a few stats, and I think it's one of the points that we'll be discussing a bit more extensively later. I mean, another elephant in the room to name is really SPACs, right? And everything that's been going on and how they've been accelerating this ability and this kind of capital in the market. I just, kind of looked at the stats. I mean, from a purely private equity side, in regular years, we were talking about 500 billion of, capitals that could be deployed. And now just with the SPACs alone, it's about 700 to 800 billion that's available for potential target companies. And I think one last point, it's just institutional investors in general. I mean, I look at myself working for CDPQ, turning to growth investments. So investing more and more into technology companies, and we're definitely not alone. So again, more capital in the market.
Right. Yeah, I think I was looking at stats on this recently. Like I know at the beginning of the pandemic, there was this talk about there being tons of dry powder in the industry. There was, tons of funds had raised record numbers of amounts of capital in 2018. So are we seeing that just still kind of fueling the system now?
So definitely still fueling the system. I mean, it's happening both on the private and public side with, the ability to grow through a SPAC or through a regular IPO, because public markets are hot as well, as we know today. Mm-hmm. And I think, I mean, it's really on the line of like, there's a lot of discussions around, are we in a bubble right now? What's going on? But again, I think there's a mix of fundamentals to my point about businesses, performing and kind of, being in line with those valuation, and the fact that some of them are actually, kind of benefiting from this overall situation. So there's really a thin line, and it's hard to say at this point, is it, an ongoing, is this set as a new valuation target, or are we going to see a readjustment in, month to come? So that's kind of the $10 million question right now.
Mm-hmm. I want to get back to that a bit, but sorry, Manica, did you want to add
one thing on that? And I think you're mentioning it between the lines, but I'll share it because I think it's something specific to us as well as others. I think we're seeing from a VC perspective a greater pace of investing and putting that capital to work this year. I don't know about you all, but my firm, we find ourselves dangerously more productive amongst COVID than we ever were. There are lots of opportunities to build upon what we've earlier talked about in terms of businesses in the market raising capital. But as a VC player, I find I'm putting capital to work at a greater pace in the last 12 months than we have previously.
Couldn't agree more with you actually on that point. Definitely, you know, I mean, digital has accelerated the way we do things, but it's also in terms of deal flow, in terms of opportunities, everything is just at a faster pace. So that's also a part of the contributor. Totally agree with you, Manica.
Manica, you had touched on, you know, new players getting into seed stages, earlier stages of investing. You kind of hinted at Tiger getting in there, but, you know, there's also retail investors, angel investors who want to dip their toes in technology investments for the first time. And Danielle, I'm hoping you can speak a little bit to, you know, what are some of the barriers that these investors who are increasingly wanting to get into the sector are still facing, and kind of what, if anything, is being done to lift those barriers?
Oh, great question. And I mean, you know, there's a lot of barriers in terms of, you know, getting into the ecosystem. I think even thinking through why there's greater valuations, we've seen two trends where obviously everyone's gone into silos for who they knew before COVID, and there's less of eventing, so everything's coming through intros. And at the same time, there's an opening of borders and more opportunities for the US and for Canada as a whole to come together and connect, because everyone is virtual. So with that in place, I'm hoping that we'll see more of this trend around democratizing investment, encouraging more women and underrepresented investors. We're certainly seeing new initiatives with Future Capital and Archangel, as well as women-specific event funds like the 51, Women's Equity Lab, SheBoot, to name a few, where women are coming together and they're able to invest directly in founders and get that firsthand experience, even virtually. So with that in mind, if people are interested in getting into angel investing, there's over 15 networks, angel networks in Ontario alone. There's organizations like Angel Investors Ontario and NACO that can support the learning process, as well as access to other angels who can mentor and support access to great deal flow. And I think a lot of founders would benefit from those early investors who will take the risks and take different risks than when it's in institutional capital.
Okay, so we've all kind of discussed, you know, the excitement we're seeing here, the activity going on here. But, you know, I'm going to go out on a limb and say, you know, there's a risk that this environment won't last in its, you know, current form, at least. I guess maybe Nayla, maybe I'll get you to speak to this first. How are you kind of weighing risks that you know, these high valuations that companies are fetching may not, you know, live up to the hype here, if that's a risk, and what other risks you might be weighing at CDPQ around this?
So, I mean, it's, again, you know, in this overall discussion, it's really top of mind for us. And it's been a very, you know, lots of debates internally to understand how much of valuations today are based on fundamentals and how much valuations are part of a, you know, inflation because of a lot of capital on the market and a lot of the ways, you know, competitive rounds are currently run. I think one thing that I'd like to advise as I speak to some entrepreneurs, whether, you know, we're already invested in company or we're getting to know them, you know, one thing to be really wary and caution maybe from the entrepreneur side is just, once you do raise at a certain valuation, it's important for you to have this ability to grow into your valuation. Because I mean, a lot of, you know, VC-based valuation is based on future projections, often looking at next 12-month projected revenues, sometimes even 2 years out, as to where the actual valuation is priced today. So, you know, it's a lot of pressure to live with, and, you know, definitely needs a lot of, the entrepreneur has to be convinced that he'll be able to deliver, because once an investor comes in at a certain valuation, and if things, you know, don't pan out, or there's not an ability to deliver on results as expected, you know, there's always kind of the loom or the threat of potentially having to go through a down round for the next raise, right? And that's definitely not something that you'd like to have in your historic of raises, just because it kind of, give a certain perspective to future investors and for future raise. So it's always something to keep in mind. It's a balancing act really that the entrepreneur has to work with between, yes, getting the best valuation, yes, limiting dilution, but at the same time, making sure that they have the ability to grow into this valuation that's been put on the table.
Right. And we just got an audience question, kind of a follow-up to that. Can valuations continue rising? And then a follow-up from me on that is, what happens if they don't? What happens if we do start seeing a bunch of these down rounds?
Sure. I'd be happy to take that one as well. So, everybody's aware. I think everybody's got their eyes on it, but public markets are showing a lot of volatility, right? Just ever since the beginning of the years, but it's been accelerating just this week alone and last week. Yes, we are talking about the private sector here, but, we tend to look at those in terms of, at least in the stages that I invest in, we look at those as, comparables and potential exit multiples. So there definitely, valuations are getting a bit of a reality check right now. So can they potentially keep on raising right now? Again, I don't have a crystal ball today, but our belief is that, there will be some kind of adjustment, or the fundamentals are key again. Coming back to, our due diligence process internally, making sure that you're really betting on the right horse, that the company that you're investing with has the ability to grow. Yes, we're working in a fast-paced environment because of the pandemic, but it's not a reason we really have to keep being diligent as we do our investment. And I think the right companies are going to be able to live up to expectations and grow into their valuation, but I think that some of them are going to get hurt in the process.
Manica, consumer retail is an area that's really lifted during the pandemic. Do you see, those risks applying to the sector too if things go back to normal?
Yeah, absolutely. I think it hits on what Nayla said about if a company is actually able to live up to the valuation that it's garnered, right? I think that the proof will be in the next little while, if some of these large valuations, these loftier valuations, if the companies, if the founders, if these startups can grow into those valuations. And if not, you will see a myriad of down rounds, sadly. And I think that in itself will shape a potential correction if there is to be one.
Okay, just shifting course here a little bit. I'm sure, there's been a lot said and written about how the pandemic has affected people differently depending on their demographics. And I'm curious to know, Danielle, from you, whether you're seeing this with founders too, in the specific stage that you're looking at are, founders who might have childcare responsibilities or maybe, taking on a second job. Are they being impacted more severely by this pandemic, or, is there enough capital in the space that they are still better off now than they would have been before the pandemic? Can you speak to that?
Yeah, absolutely. And, immediately post, COVID in a way, right? When COVID first hit, we launched a survey with the Chamber of Commerce for Women to determine what was taking place within our networks of underrepresented founders. And we did see an incredible effect, and it was all very negative in terms of every question that we were asking, but at the same time, it was very much an industry specific impact rather than demographic. And so what I saw was there tended to be more women and underrepresented founders in industries that were directly affected, especially given speaking and eventing. And so overall, with the pandemic, I think it's definitely had a greater impact on women and not being able to join the workforce. But in terms of build mode and being able to continue to launch startups, I think women are launching baby startups and companies. And so I think there's some positivity there in terms of continuing to grow. And I think with the increasing number of women entering venture capital and angel investing, we'll see more investment in women as well. Just to keep things more positive, but it has obviously been a challenge for working women.
Yeah. Okay, we told our audience we were going to talk about SPACs, and Nayla, you'd kind of flicked at this earlier too. So let's talk a little bit more about how the SPAC trend, this rush of blank check companies onto the market, how that's affecting venture capital, our firms competing with SPACs. Do you anticipate they will be competing with SPACs? What does that look like? Nayla, do you want to start with that?
Yeah, for sure. It'd be my pleasure. So, we definitely, like a lot of investors here, a lot of investors in VC, we've definitely came across SPACs, from different angles, whether it's, potentially a target company looking for an exit, or, looking at it from a even sponsor or investing at a pipe level. So, definitely just to come back on the initial premise of a SPAC to me, it's an additional tool in the toolbox that companies have today. They've, definitely accelerated the ability of certain VC-backed companies to go public. As we know, the process is faster than a traditional IPO. But I think really the big point here is that SPACs allow you to present projections. And to my point earlier, a lot of VC-backed companies, a lot of the stories come from the future growth and where, they plan on being 1 year, 2 year, 3 years from now. And that was something that couldn't necessarily be presented at an IPO stage, right? It's as a SPAC though, you have this ability to give the complete story. So definitely a tool to be looked at. Now to answer your question specifically about how it impacts us in the way we deal and are we actually running into competitions with them? I'd like to think that, a lot of the good SPAC candidates are not necessarily the typical profile of companies that we will look at CDPQ specifically. Just to remind people a bit that know us a bit less, we have more of a conservative VC approach, which might sound like an oxymoron at first, but really thinking as we invest for our depositors, yes, we're looking for returns, but we're also managing risk. So one of the things to note is that we tend to focus on B2B SaaS companies. We tend to shy away from oversubscribed raises with very high valuations. And we're also looking for companies with, growth, definitely, but not, a 30 to 40% growth to me is a very decent growth company. And, as long as, the cash burn is reasonable, that's fine. If I look at SPAC candidates today, they tend to be more on I'm generalizing here a bit. There's a lot of case by case, but there's a lot of binary situations, right? Companies who are, more earlier on in their stage, who definitely need to kind of show a bit of operational maturity, maybe. They tend to be maybe more, B2C oriented versus B2B, like more brand names that are recognized by retail and public investors. So that's why it's been a bit less of a direct competition for us. Another point, again, as I discussed, we do have this investment continuum, so we still have the ability to invest in pipes if we wanted to, or to invest when the company's gone public. So we're able to kind of invest in those companies at a later stage as well.
I guess more directly, like, have you seen portfolio companies be approached by SPACs recently?
Unfortunately, I'm not at liberty to really give a lot of details there, but if I just look at the general market trends, and a lot of people around the table or VC investors listening in have probably faced a similar situation. There's a lot of companies even at Series B, Series C's level that are approached on a daily basis, right? There's tons of SPACs looking for potential targets right now, working on a 2-year deadline before they actually need to close within a 2-year deadline. So a lot of timing and capital in the market. So I guess as a general question, as a general answer, I'm sure lots of VC-backed companies are being approached by SPACs right now.
Manica, I know you're dealing with earlier stage companies, but is this something you're coming up against as well?
Yeah, I would echo what Nayla said. We view it more as a positive overall in terms of a path to potential exit. I've welcomed the trend somewhat for that reason. Now there are a bunch of reasons Nayla gave why they're attractive, but I think there's also the fact that you're giving up about 20%. So from a dilution standpoint, it's a consideration, right, that you shouldn't take lightly as a board and as a startup if you're being faced with that proposition. But for the most part, I would say that we view it as a potential additional path to exit. Yeah, and we're not competitive with them at our stage, given given that we're so early.
Great. Okay. I know, so I guess in some sense, a SPAC or a blank check company that comes in, goes public, and then acquires a company through that means that in some way might be viewed as a slight disruptor to the venture capital industry. But I'm wondering if there are other kind of innovations disrupting or shaking up the space a little bit, not just in terms of the companies that VCs are investing in, but how they're going about doing that. Danielle, can you speak to that? Are you seeing, innovations within firms and, how they're rolling out their funds?
Oh, good question. I mean, certainly we're seeing an increase in corporate venture capital, which I think can be very beneficial and strategic for startups if done well. I also see increases in crowdfunding and other earlier stage mechanisms for fundraising, which is great because a lot of women succeed in crowdfunding at higher rates, particularly fund groups like Equivesto, where it's been deregulated to invest as a non-accredited angel individual, up to 10K in Ontario, and in other provinces, it's also being deregulated to allow for more participation. So we're seeing some of those trends. I think everyone's seen what Michelle Romanov has done with Clearbank and Clearco. So these types of, even revenue-based investment models exist in other countries to a large extent and have been evolving for 10, 15, 20 years. But in Canada, it has been a lot more of the conservative VCs that came out of private equity. So I am encouraged to see more diversity in the type of funds and the mechanisms for that capital.
Nayla, what are you seeing there as well? Can you speak to innovation you're seeing or would like to see in the venture capital space at firms?
So, I mean, a lot of, we've discussed SPACs, a lot of raising valuation. I think a lot of those trends have been discussed. I think to Daniel's point, we're also putting a big emphasis here at CDPQ on diversity in general. We actually have a 250 million fund that's specifically dedicated to diversity. It's called 25 times third because we look at diversity at the board administrator level, at the ownership level, and at the management level. So it's important for us to have it really at three. And the idea is not to have a company today that meets all our criteria. It's to work with the company to make sure that it's part of their philosophy and their approach and that they grow into that as they go forward. So definitely a big emphasis for us. Another big one is definitely clean tech in general, right? A lot of clean tech focused investments, thinking about, investing in companies that are driving tomorrow's future and how they will impact our overall the environment and just work through that as well. So that's definitely a big one. There's been a lot of I think there's been a few articles that were circulated around there, but maybe just to remind everyone, I'm getting a bit more on the personal side, but our own remuneration here internally as an investment professional at CDPQ is linked and tied to the investment choices that we made as how they pertain to actually investing in a carbon neutral and actually carbon reversing companies. So it's definitely a major focus, and it's not just talk. It's really it's in our goals and our investment objectives on a daily basis.
And Manica, I'll throw that one to you too, just to get your perspective on that.
I think Danielle and Nayla have covered it off really well, but I think the only thing that I would add, and maybe this is an obvious one, but amidst COVID, I think just how innovative we've all become in terms of, if you asked maybe any three of us 18 months ago if we would ever close a deal without having shaken hands with a founder, sat in a room and, talked through strategic planning and all the various elements of diligence that we do that historically has been very face-to-face. I think that in itself to me has been somewhat of an innovation that's I think taken our world by surprise in terms of just how productive we've been in continuing to deploy capital, in leveraging technology ourselves to do that. So I think I'm hopeful that trend will continue. I think we've seen founder teams and early stage startup teams some of which have never met each other. They do all their business virtually and leveraging innovation and technology, within their own four walls. So I think that's an innovation that we're going to continue to see. I would bucket that in innovation.
Great. So in the past week, with the past few days, definitely we've seen a bunch of volatility in the public markets around, largely tied to fears that inflation would increase. So I'm wondering how venture capital is tied to inflation, if there are similar risks or fears linked to venture capital with the increase potentially of inflation here. Manica, why don't we go to you with that one too?
Sure. I mean, I would say I'm not seeing it as much of as a risk. I mean, I think overall inflation is something that we all think about, and it's a macro level concern. But in the world of VC, as it regards to my industry and consumer spending, it'll increase in step with consumer spending as well. So I'm not, maybe I should be more concerned, but it's certainly not something that keeps me up at night.
Okay, Nayla, thoughts on that?
I would tend to go in the same direction as Manica, but I mean, on a, kind of to your point about markets and volatility, and it's a point that I made earlier, I mean, it's definitely impacting valuations in the technology segments. I mean, we've seen a lot of shifts on public markets where investors, institutional investors, are readjusting their portfolio allocation, selling off tech to go into more secure and less inflation impacted sectors. So, again, seeing kind of the starting a bit maybe of a downward trend on valuation. So, as we invest later stage in private company, we look at those again as our markers, right? As to, how is this, what would be a proper multiple to apply to this company? And if I see valuations going down in the public segment, it's definitely going to have an impact as to how I price, companies on the private sector as well.
Right. When we're talking about competition for, increased competition among firms for a smaller pool of companies here, how does investing outside of Canada play into that? How is that being leveraged, if at all, as a tool to kind of broaden the pool for investors? Nayla, can you speak to that from CDPQ's perspective?
Sure. Yeah, definitely. I mean, very valid point. I mean, if you turn, to the US, for instance, it's a very extremely competitive market right now. But our approach is a bit similar to the way we've built our practice or our mandate in Canada. It's based on relationships, right? We have within CDPQ a team that's dedicated into funds investing as well. So they tend to invest in funds at earlier stage and, Series C's and Series B, which are stages at which we do not invest directly. But the idea is to really cover grounds to establish relationship, outside of Canada. So we have a few, we're investors in a few US tier 1 funds. And through them, we've been building relationship, building, deal flow and co-investment opportunities. We've actually done the same. We have a team based out of London and a team based out of Singapore. So we're also working with them. And we also are investors in Asian and European funds. And it's really a partnership approach. It's building a network. It's, talking to them on a regular basis. And we're taking it step by step. I mean, we have our name and our brand has been known in Canada. We also have the benefit of being known in terms of a brand and CDPQ recognition in our infrastructure teams and private equity teams, which have been on the ground for quite a while now. So the VC is something that we're establishing right now. A lot of activity going on definitely in the States, but also in Asia and Europe. Just to name one, we've recently, our Singapore team just led recently a round in Druva, which is a global leader in cloud data protection and management. It was initially an Indian startup who now it's headquartered in California, but that's an example of the kind of partnerships-led investment that we like to do.
Mm. And Manica, I know BrandProject, you guys, a lot of your investments are based in the States, right?
Yeah, so yeah, I'm not sure if the question really applies just because 80% of what we typically invest in is US based. That being said, of the 3 deals that we've recently closed in the last month, actually, one of them has been Canadian. So we're batting, I guess, no, 2 actually. There's one that's been Canadian, and there are 2 in the pipe that are Canadian opportunities right now that are sort of term sheet signed level. So I would say that we've been more active in Canada recently, but it's been where the opportunities are. I mean, we're looking for the best opportunities across Canada and the US. Like I said, historically, for the most part, we found more to do in the US, but we are finding lots in Canada right now.
Right. And just briefly going back to the SPACs question here, someone from the audience made the good point of aren't SPACs, we typically hear of them as being an American thing. This is happening more in the US. So Nayla and Manica, when you're talking about, seeing activity around SPACs, are these with regards to US companies you're looking at or also Canadian firms?
Yeah, sorry.
No, go ahead, Manica.
I would say I'm seeing it more in the US.
So yes, from a SPAC sponsor standpoint, definitely more on the US side. There are a few Canadian ones who also, kind of benefiting from this trend. But from a target standpoint, US, Canada, there's no real differentiation as long as, so for a potential company that would be merging with a SPAC, it's on both sides.
Okay. Also, just kind of sticking with the international view here, this is another question from an audience member that is interesting. Where do Canadian VCs rank in the world in terms of success metrics, as the industry would define those? I don't know if that's something any of you are able to speak. I'm interested in this question at every stage, so I'd love to hear from all of you on this one.
Sure. I'd love to take a first shot at it, but I'll speak in general terms. As I mentioned, we do have an internal funds investment group who invests in Canadian VCs. So, what we're seeing now is that there's definitely, just to go back in time, as we know, historically, the US has a kind of a runway, a much longer runway than we do specifically in VCs. We've started later than they did. But what's important to note is that we're definitely seeing the rise of very, known and good position VC companies based out of Canada. Just, Inovia or Georgian Partners, to name a few at the stage level that I invest in, definitely have a recognized international brand today. Done quite a few successful exits, have positioned themselves to go forward. So I think we're very well positioned in Canada to keep growing and to keep seeing more of those funds manager, rise up to the international ranks. So I think it's a very good time for VC funds right now.
Manica, I don't know if you can speak more to this as well. I'm also interested kind of like specifically what we're seeing on IRR. I don't know if that's something you can talk about, internal rate of return that Canadian firms might be seeing relative to US or European counterparts.
Yeah, I don't have that data to go by. Like Nayla, we don't have an internal group that invests in funds, so I'm not entirely sure how exactly, in general, the Canadian landscape compares to the U.S. But I would echo what Nayla said in terms of, especially recently, firms that you may not have heard of 5 years ago are certainly on the international map today through some substantial exodus, especially recently in the cases of Inovia and Georgian and Rhino with Thinkific recently. Even on our side with BrandProject, we had our first unicorn late last year. One of our portfolio companies freshly sold to Nestle for $1.5 billion. So that was huge for us, certainly put us on the map. We're really proud of that, and hopefully the first of many more. So I think that we've made large advances in the last several years, given the fact that we don't have the head start that the U.S. had. But I don't know specifically from an IRR perspective how on balance our firms compare to the U.S.
Okay. And Danielle, what does the angel space look like here in Canada relative to the United States?
Yeah, I would say there's a bigger difference there. There's a lot of participation and a lot of money and a lot of risk taking in those early stages. So very interested to find that specific data point of comparison, because we speak about it as a gap. But rough estimate would be maybe a quarter per capita in Canada at these stages compared to the US. And so the opportunities at the earliest stages in Canada are in some ways balanced out by the amount of government funding that comes through, but people are definitely taking more risks in the angel stages in the US. But overall, I would say from a success metrics, I think Canada is actually more similar than we'd like to say to the rest of the world, and we're playing in a global way. And I've been participating more in European events, and that's one of the benefits of being virtual. So seeing more of the world and the way that they participate. And early stage companies are early stage companies, no matter where you are. So a lot of similar requests and questions to them.
Okay, great. Nayla, you're muted there.
Oh, can you hear me now?
There we go. Yes, great.
Yeah, I was just going to add a follow-up point to that question. Not necessarily, I don't have metrics to provide per se, but to Danielle's point and Manica's point, I mean, VC Canadians play in the same field as Americans or European. We are definitely in a global world right now, so the opportunities are the same. They of course they know better. Maybe they're Canadian based companies than a VC fund would, but they have these same objectives and targets and metrics. And it's not, I think we are on, if you look at our top tier funds, we are on par with where a US fund would be as well. So
okay, great. Nayla, you talked a lot about how the fundamentals is what it comes down to when you're looking at companies to invest in. Danielle, what at the earliest stages are investors looking for? Like if a company, if a founder is listening in on this call and they want to know how to approach their first raise, like what are kind of the key things that you're going to be looking for there?
The $1 million question, the seed stage question. I mean, there's the fundamentals around the team. If someone's experienced and they've had an exit before, that's a plus. The market, is it big enough? Is it VC grade? Do you have your SAM, TAM, SOM worked out? Can we take a look? The product and the technology, how much have you built out? What stage is it at? Do you have patents? Do you have protective moat around it that can differentiate you over time? And what's your go-to-market? Like, how are you going to make this feasible? And with your projections, is that going to look something that like we can invest in and see those returns? So it's the same thing over and over again. I think for a founder to prepare for investment, they definitely need to have a solid pitch deck, significant amount of work put into that to articulate a broad range of these elements that I've just articulated, as well as their due diligence documents in place, their data room, so that VCs can determine, is what you're pitching and what you're presenting, is it all accurate? So all of those fundamentals can be taught in the incubators, and there's a wide range of them. Always look them up locally. I think even in virtual times, it's nice to have some familiar faces locally. So I would encourage founders to see what startup services are available.
Okay, we are nearing the end of the call here. So I just want to get kind of some rapid fire predictions from everyone on what they're expecting to see, what they're hoping to see in the next few months to a year. Manica, let's go to you first. What are your predictions?
Well, I'm not sure if this is what I'm hoping to see in the next little while, but I definitely see from an exit perspective, I see the SPACs and the IPOs continuing. I see in my sector, specifically in consumer, I see more scrutiny from an FTC perspective. There have been certain, in personal care side, there have been certain acquisitions that have been blocked by strategics, and that's traditionally been our exit path. So I see a little bit more of that coming. And I would say one thing to watch is going to be how we all evolve post-COVID. My prediction is that there are certain things that will go back to the way that they were, and I think there's going to be a number of things that won't. I think, my comment earlier, especially around startup teams, some members are working remotely that have never met each other. I think that could be a trend that we see persist in terms of remote working. And that's that. Those would be my top ones.
Great. Okay. And then quickly to Danielle, what are you going to see, or what do you hope to see? What do you expect?
Well, I think everyone can hope for more acquisitions, right? More money in the ecosystem drives more ecosystem activity. So let's hope for more acquisitions. My prediction would be that there would actually be a continuous in terms of more early stage acquisitions and acqui-hires for top talent. So Canada more on the world stage, getting more recognition means there's going to be more attention from other countries to acquire, to invest, and to look at Canadian tech and Canadian talent. So, we may want to think about protecting it a little bit as well. And I also see the trends with VC funds where they're growing, and there's going to be more billion-dollar funds. And so is that reflective of what's happening in Canada? Maybe not. And they'll probably invest in more American companies as well. So I think we'll see a lot more cross-border activity.
Great. Okay. And then to you, Nayla, predictions.
Really quick on my end. I think, definitely an ongoing trend, definitely an increased appetite from investors at all stages to keep investing in VC. I think just speaking to the later stage and to, pension funds and CDPQ in particular, it's definitely part of our DNA today. Technology investments is, an underlying trend. VC investment is definitely something that is acquired in the organization. So it's a place where we're going to keep on investing for the future to come.
Okay, great. Well, thank you all so much. This is great. I really appreciate you all joining us today. I found this incredibly interesting and informative, and I hope the audience did as well. Thanks so much.
Thank you.
Thanks.
I also want to thank our business team at The Logic and our producer, John Packman, for running the show here. Thanks so much. And thank you to everyone who tuned in as an audience member for this call. We know there are tons of these virtual events. We've been doing this for over a year now, and we really do appreciate you taking the time out of your day to join ours. So thanks so much. A reminder that you can follow The Logic on Twitter, on Instagram, LinkedIn, Facebook. And if you haven't yet, please subscribe to The Logic for more events like this and for in-depth original journalism. You can find us at thelogic.co. Thanks so much, everyone, and take care.